Hi, I'm Toby,
And I'm Nick.
and welcome to another episode of the Pure Property Podcast from Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you our industry insight and knowledge in bite-sized chunks to help investors invest intelligently. This recording is taking place during our first week of, things opening back up and the relaxations taking place. And yeah, it's nice to see some people back outside in the streets in London enjoying themselves. It's definitely a bit busier, isn't it, Nick?
Yeah, definitely. I mean, I've been coming in most of lockdown, as obviously the property market can technically continue. So yeah, it's really nice to see the buzz this week. So on that note, if anyone's in and around London and they're interested in meeting face to face, either in our office or perhaps somewhere nearby, obviously you're welcome to do so. So do get in touch if anyone fancies that at all.
Yeah, so this week we've got, an interesting one and probably going to be a fun one for Nick and I. It's a surprise Q&A. So me and Nick are going to ask each other questions, and we have no idea what each of us is asking. So it is going to be a genuine off-the-cuff response from both of us. That's either going to be a very good thing or a very bad thing, depending on the questions. So yes, who do you want to start off, Nick? Do you want to ask a question first, or do you want me?
Why don't I start off by testing yourself? So yeah, as we mentioned last week, trying to keep it a bit more fluid this week, because we typically do a lot of reading and research, and we like to structure our podcast to try and get to try and deliver as much value as possible, basically. So yeah, as Toby says, this week a bit more of a freestyle structure. So yeah, I'll kick things off then, Toby, and if we alternate, and we'll go from there. So. The only other sort of thing I would say is that we've tried to keep it in terms of what investors may ask us, because obviously we want to make sure it's as relevant as possible. So, yep, I'll start off then. So, number one, I'm thinking of buying freehold. What would you say is the advantage of perhaps going for leasehold? Because I've heard the charges are high.
Oh, good question. Now, I would say the advantages of buying leasehold, they are that it's a more hands-off and, in some aspects, stress-free investment. Freehold obviously has the advantages on a monthly cash flow basis of not having the service charge and ground rent. Now, what can also take place with a freehold is when you do have something go wrong, and it goes wrong big, because you're the sole responsible party to pay for such things gone wrong, it can be very, very expensive. I can give you an example recently of one of mine where the roof had major issues, bad weather, a bit of wear and tear, and meant we had massive issues with the roof. Insurance didn't cover it, and that's cost me, I think all in all, because it did get into the bathroom, cost me near enough £3,000. Now, leasehold, you pay a monthly basis for the upkeep and the general upkeep of the building, communal grounds. So other advantages there. There's less chance of a big thing going wrong because they are on top of it and constantly maintaining. Also, the grounds and the communal areas are kept looking very, very nice, which is very important, because when you're trying to get a high caliber of tenant, you want things to look nice. When you own a freehold, if the tenant's not looking after the house, or even the outside of the house next door, or the house outside of the house a couple doors down, that is going to reflect on your property as well. Whereas in a block of apartments, it's looked after, it's maintained, it's kept nice, kept fresh, kept clean, and that definitely helps when attracting tenants and coming to rent your property. So that's, I would say, the main benefits of the leasehold. It's that the looking after, less for you to do, less phone calls for you, and less chance of big things going wrong, especially in the new builds. The new builds are built very, very well. They're new, they're brand spanking new. You have warranties as well. So again, deviating off slightly the leasehold, but the ones we deal with, again, that's another advantage. The other advantage is you've got the warranties, for example, the NHBC, valid for 10 years. You've also got the predictability aspect to it as well. So you know roughly on a monthly basis what you're going to be paying, which again helps with factoring in your returns, your cash flow, and no surprises that might catch you out in 1 month.
Perfect. So that's a really good summary there, and hopefully answered the investors' question adequately. So yeah, do you want to fire away?
Yeah, I'm just trying to think which question to ask you because I've got a few here, but I'm thinking do I save one till last? But yeah, no, I'll go ahead. So, where do you think is the best place to invest at the moment?
Oh wow, okay, that's that's a big bomb. Okay, so yeah, I mean, I'd certainly say it would depend on the investor's objectives. You know, ultimately, what are they looking to try and achieve in the long term? When typically speak to an investor, the first thing I'll do is ask them plenty of questions about their situation, their circumstances, and what they're looking to achieve. So their budget, their time frames, their risk profile. Are they more income or yield focused, and any other sort of specifics concerns or questions they might have? And after I have that material, that's when I'll be able to make a recommendation. Off the top of my head, I'd say if someone's looking to typically stay to around an entry level one bedroom apartment between 100 and 150,000, and they want a good balance of rental yield and capital growth, I would say focus on Liverpool. The reason being, it's slightly cheaper than the likes of Manchester, Birmingham, and obviously cheaper than London. Having said that, the rental yields are really high, and the capital growth itself is extremely attractive, both at the moment, in the future, and it has been in recent years as well. So, I'd say for those looking to try and build and establish your portfolio in the UK, Liverpool would be a great place to start. Perhaps if I had someone that was a bit more risk averse and wanted, perhaps a really safe bet and wasn't as restrictive on budget, then I'd say look at Manchester. So the reason I'd say that is because ultimately it's got the investment fundamentals there, which are really strong, probably slightly more favourable than Liverpool. So you've got education, employers, investment, regeneration, and then really strong transport links as well. So perhaps for someone that's looking for something slightly more safer, where they really know the capital growth is going to be probably the best in the country over the next 5 years, then I'd say Manchester. But yeah, at the top of my head, if I had to pick two of the best cities in the UK at the moment, it would be Liverpool and Manchester.
I cheated a bit there. I said pick the best place, but it was a very well thought out and comprehensive answer. So I'll let you have that one. I'll let you have that.
Good. Okay, so my turn again now. Which one shall we look at? So, what is interest on deposit? You've seen this advertised on some investments out there, particularly in the off-plan market. So, if an investor asks you, "What does interest on deposit mean?" How would you explain that?
So I would explain that as in how we deal with the property investments and the off plan. It's an incentive offered by the developer whereby they will pay the investor a certain amount of interest on the funds that an investor puts in as their deposit, obviously on exchange of contracts, and it's built up over the construction period and usually comes off of the final purchase price on completion. For example, just for argument's sake, if a investor put in £10,000 as a deposit on exchange of contracts when buying their investment, and the developer has an incentive where they will pay 3% interest during the construction period, and the construction takes a year because it tends to be per annum that they'll pay this, then they would be entitled to a £300 discount to come off the purchase price on completion. That's sort of it in a nutshell, and as a rule of thumb as well. Some developers will structure it slightly different, but that tends to be the majority of the way that incentive is set up.
Perfect. And yeah, I think that it ranges typically we see 3 to 5%, sometimes a touch higher. But yeah, interest on deposits an interesting one to look for off-plan investment.
Great. Right. My turn now. Why is it good to invest off plan?
Okay, another meaty one. So, yeah, I think it comes down to effectively your return on investment. One of the things that we notice when we're speaking to investors is that what you'll find is they tend to broadly fall into a couple of categories with regard to their opinion of off-plan investing. Like some people believe that you automatically get a discount because you're buying in advance during the construction period. Others believe that some of them can be overpriced, maybe because sometimes they're used to looking at big corporate developers, where they're public companies, and they might price developments a bit higher. So yeah, what I would say is certainly take things on a case by case basis. So every development will be different, and each developer will obviously structure and price the scheme suited to their potential requirements. So a lot of the time, you can secure a discount and you get a cheaper price. They also chuck in incentives, like we mentioned earlier, interest on deposit, so you can get your money working for you straight away. And then you can also secure often rental assurances when the project completes. So effectively, that would be a contractually guaranteed rent, typically for a year or two on a residential property. So the short answer to the question is you can, if you pick the right development and work with the right companies, significantly increase your return on investment throughout ownership by purchasing off plan in advance. You get to pick the best unit in the schemes. You get to pick the best units in the schemes, perhaps with views, balconies. You're buying at base pricing from the developer, you're getting investor incentives, and you're getting a brand new property with a building warranty. So when you add all those bits up and you're going with a safe, reliable partner, then off-plan investment can be much more favorable rather than going for, an older, 5-10 year rundown property with a limited warranty, etc., etc. So hopefully that gives a quick overview.
Yeah, great answer. I think also just to add on to that, and it's only relevant because of the market we find ourselves in at the moment. The one thing I definitely see as an advantage at the moment is you're not up against lots of other viewers and bidders and getting yourself into bidding wars and getting outbid and driving up the prices. You're in a much stronger position to negotiate as well because it's just you and the developer speaking. Whereas at the moment, the market is so buoyant. If you go out and view a property, I guarantee if it's a good market in good location, you're going to be up against lots of other purchasers in various positions, investors, homeowners, cash buyers, etc., etc. It's driving up the price. You get into a bidding war and you can sometimes end up overpaying. So that's just one thing I think is definitely relevant and advantage at the moment in purchasing off plan, and yeah, the new build process we have at the moment.
Yeah, very good point, and that's obviously particularly relevant in the type of cities that we're working in. So those popular regional cities are in incredibly high demand. So Manchester, Liverpool, Leeds, etc. So yeah, really, really good point there. Cool. Moving on to the next one then. So this one would be an investor that's based overseas, and they're asking, how does the management of the property work? I don't live near the property. I'm not able to visit it. So who's going to manage it for me? So how would you run through the management process, Toby?
Excellent question. So, effectively, in simple terms, you employ a managing slash letting agent to fully manage the property. So, you would work with a company like ourselves if you don't have the connections already here, and we can then we can source a local letting agent who can then take the property on for you. They will find the tenant, vet the tenant, i.e., reference them. They will get the contract signed up, put the tenant into the property, and then manage the property from there on, collecting the rent. Also, with overseas investors, you will need your annual statement as well of accounts, which again, the letting agent would provide for you, and they will charge you a percentage of the monthly rental income as their fee. And this can range typically depending on the level of service, but fully managed can range anywhere from 8 to 12% plus VAT. It's a service that, even if you're not an overseas investor, I highly recommend. I use it on my investment properties, even ones, as I've mentioned previously, that are on my doorstep, and I'm able to visit them if need be. It's just definitely a service that is worth its weight in gold, and it takes a lot of stress, hassle, and time off of an investor's plate. So that is in simple terms, how they would manage the properties from overseas.
Yeah, perfect. And then the other point, of course, is that they will keep you fully informed of any changes in the law or regulation and things like that. So you just have the peace of mind that effectively you're up to date on everything. Because as we know, the UK market with regards to landlord regulation is constantly changing. So yeah, really good points there.
Excellent. Yeah, especially when you've got sort of the gas safety certificates and the new electrical regulations that have come in. That's something that the lettings company will take care of for you. So, yeah, very good point there, Nick. All right, my question. So, when will be the next property market crash, Nick? So, when do you think might be the next property price crash?
A nice positive question then. Okay, cool. So, I mean, I don't really like the term crash because it implies that it's going to be exceptionally dramatic. Obviously, all markets do have fluctuations, and some markets perform better than others. Where we are at the moment, in terms of the resurgence of the economy in general from the coronavirus pandemic and also Brexit as well. I see in the medium term or short to medium term, no issues at all. I think there's going to be strong growth in the market and very very positive news, and I think that's only going to be amplified this year in the next 3 or 4 years. I think after that, I think there may be a slight dip when perhaps we see the true underlying unemployment rate, i.e., when furlough ends and stuff like that. You then see the knock-on effect for a few years after. But yeah, I think in the short term, short to medium term, we're going to be absolutely fine. But then you might see a slight dip before we restart things again and go forward. What do you think, Toby?
Oh wait, you're not allowed to bounce the question back onto me. That's not fair. Nah, I'm joking. No, in short, I won't go on too much because you've covered it well. But yeah, I don't see the market crash happening anytime soon. The fundamentals in the property market are there, such as your low interest rates, which don't seem to be going anywhere anytime soon. You've also got the massive issue that this country has of a supply and demand imbalance. Demand is high and supply is low, and we're not building enough houses to fix that problem. So in short, I would say we are safe for at least the next 2 years, but of course we take that on a year by year basis as things do change.
Perfect. Okay, cool. So we'll roll off a couple more then. So a couple of quick ones for you, or sorry, one quick one for you. What are the costs involved during a property purchase?
Great question. So I'll take this as one of our investor clients, i.e., sort of buying a new build / off plan. So your costs are going to be, if you're buying with a mortgage, you may have a mortgage broker fee. You'll also have a fee that the lender will charge, but that tends to get added onto the mortgage as well. So you won't actually physically pay that out. But if your broker has a fee, which majority do, you'll pay the mortgage broker. And that can be anywhere from £700-800, depending. Again, just depends on your mortgage broker. You'll have solicitor fees. Again, these do range whether you're buying in your personal name, limited company. That can be anywhere from £900 plus VAT up to £1,200 plus VAT, plus your searches, which can be a few £100s, etc., and maybe some disbursements. Then you will have, when you complete, you'll have stamp duty costs. Again, quite a big cost to factor in depending at the price level. We will put a stamp duty calculator link in the show notes because I won't go into how it's broken down because, yeah, it can be quite confusing when explaining it. But a calculator is the easiest way to figure out how much you'd pay on that. If you're furnishing the property, you may be paying for a furniture pack, or you may source the furniture yourself. Again, that can be a couple of £1,000s, depending on the size of the property, and also potentially a parking space. If there is parking available at development, there can be a charge for that, and that is development dependent. Apart from that, they're your main fees, and they're the ones that I can think of.
Excellent. All very straightforward stuff. And yeah, the only thing I'd add there is that a good broker is going to list all these out and make them very transparent for you before you commit to a purchase. And then also, just as a final note, you may see that some companies do charge sourcing or administration fees as well. Glad to say Track Capital doesn't, but it is potentially possible if you're searching the market as well. So all covered off nicely there. Do you want to go on to the next one, Toby?
Yes. So, Nick, I'm looking to buy a off-plan property. It's going to be built in about 18 months. How is my deposit protected?
Okay, cool. So, firstly, again, it would depend from development to development. Different investment providers have different levels of protection. So, if your deposit level is slightly higher, you might see that it's not all covered. Now, to start off, across the board, new build warranties cover 10% of deposit levels. So that means that whatever your deposit level is, 10% of that will ultimately be protected through the new build warranty. So if you have a deposit of 30%, 10% of that is automatically protected. Now, what you will find is some developers will give investors effectively a trustee agreement and a charge over the land, which means that they can add additional security derived from the valuation of the land for that remaining balance. Now, that doesn't always occur, but it is possible to achieve that as well in a new build purchase. And just as a final point, a lot of developments have what's called a long stop date. So that means that if the developer doesn't actually deliver the scheme by this date, technically investors do have the opportunity to cancel contracts and obviously exit the transaction effectively and recoup their capital. So, yeah, 10% through the new build warranty. Sometimes you'll see extra protection from developers with regards to protecting the remaining deposit levels, normally through the security of the land. And then finally, you've got the long stop date as an investor, which is sets time limit to give investors a bit more of a peace of mind.
Yeah, great. Hit the nail on the head there. Absolutely fine.
Cool. So moving on to my last question, then I believe, bit of a broad one here. So how does Track Capital help an investor? Or if an investor says it, how does Track Capital help me? Why should I use you guys?
Great question. Great question. So, how does Track Capital help and why should they use us? Track Capital are an investment consultancy. So, we like to describe ourselves as consultants because that is what we do. We consult with you. We don't have a bias to a particular development or developer. We advise on potential property investments based on an investor's strategy. And we do that by asking them specific questions and working out and finding out their specific strategy that they're working to. And once we know the strategy, we can make recommendations based on that. And we can help them through the whole process, start to finish, and also post purchase as well. We are here to help as much as possible. So, in the specific example of a newish investor, we help them find potential investments and we show them difference. So, unless they're really focused on one investment specifically, we will show them different investments so they can compare, see what works best for them and what suits their needs much better. Once we then find that investment, or once we then pick out a development, we're then able to assist them with picking the better unit that we can find, or the best unit we can find within their budget and their criteria. Once we've secured that, we then help them through the purchase process. We can guide them to find mortgage brokers. We can help them with solicitors. We also help them through those processes as well, because again, if it is new to them and they haven't been through that process, all this can be quite daunting. So with our experience of doing this technically on a day-to-day basis, we're able to assist them through every single stage. So we can help them with the mortgage process. Obviously, they will most probably have a broker, but we can assist with any questions and give a third piece of advice if needed. Again, with the solicitors, we can help them through the legal process, give them sort of the nudge where needed, if they need to sort of push forward in any certain circumstances. And then once they've exchanged and then also completed, we can help them rent the property out. So we can source them letting agents to take care of that property for them. And even after that stage, if there's any problems, any issues they have, or any questions, we are still there to help them out. Because again, it can be quite daunting for them if they've got a letting agent that they don't really know and don't have that sort of trust or rapport with. They may give us a call to say, oh, look, Toby, or look, Nick, or Tina, look, is what they're saying correct? Is this right? Should they be doing this? And again, we're on hand to help them. So in short, we will consult as best as possible in a transparent and honest way. And we do pride ourselves on integrity in that side of things as well. And we'll help them through the whole process, start to finish, and post as much or as little as needed.
Perfect. Yeah, really good summary there. And I just wanted to stress on that point as well. That we effectively have an after sales service, so it's really important that we focus and help our investors from start to finish, and making sure we are there as that point of contact. Not only because we want to be helpful, obviously we want to encourage repeat business and referrals, etc. So it is a commercial matter as well. But yeah, as Toby explained, we're there from the start to assist source developments and then guide you through every step of the process as well. So that's that question done.
Right, my final question. And again, I'm going to take this from an overseas investor point of view. So I am not a UK citizen. Can I buy a property in England?
Okay, perfect. So that's a pretty straightforward one, and it's surprisingly common actually. But the short answer is yes. It doesn't really make much of a difference. Your legal ownership stance will be the same as a domestic investor. You will have the title deeds, and you'll be the registered legal owner, and ultimately it will form part of your estate as well. So, yeah, the short answer to that is yes. You can proceed with a purchase. A couple of things to bear in mind. Obviously, some countries have capital control, so they restrict the amount of funds that can leave a country, which some people get unstuck by sometimes. And obviously, stamp duty fluctuates depending on if you're a resident or non-resident as well. So there are a couple of factors to consider. But overall, if you want to purchase a property in the UK, then you're absolutely fine too in most cases.
Excellent answer. Right, I think that's all we've got time for this week. And yeah, that was actually really good. A lot better than I thought it was going to be. I was a bit worried that you were going to ask me some really, really scary questions.
Didn't get caught out, don't worry.
No. Hopefully, we demonstrated that we sometimes know what we're talking about. So that was good.
Good stuff. So yeah, that was hopefully gave a variety of questions as well, not just the same old stuff. So yeah, maybe we'll do this again sometime. And next week we have coming up.
Yes. So next week we're going to be talking about the top 5 things to consider before investing in property. So we will see you next week for that episode. And if there's anything we have discussed today which you would like to discuss further with any members of the team, please feel free to get in touch. Thank you for joining us, and we'll see you next time.